Good afternoon, everybody. This is Chris Robinson, Robinson Ag Marketing, with today's post-close grain and livestock comments. A little bit of news today. Some of the ethanol plants in the Western Corn Belt were closing early because they're full up. That was the sort of social media news that's out there. So that they're right now they're not looking for a whole lot of corn. Uh, we'll see what happens if that changes. China bought around 600,000 metric tons of beans this week. So that brings them up to about 10 million of the 12 million that they promised. Um, we'll have to see what happens again after this USDA report, which is on the 12th. So China continues to, be kind of at least stepping in there and getting some of those beans bought uh, somewhat begrudgingly. Although you got to realize we just hit 3 month lows, right? And I think maybe part of this 30-cent bounce that we had, because remember we traded down to 1038 in March beans. We hit 68 today, couldn't get the 69 print. Ended up with a reversal, another 13-cent range, but we kind of settled on our heels under 1050, under 1057. We settled at 1056 and a quarter. A quiet day in corn, 3-4 cent range. A high 47, a low 43 and a half, down a half cent. I think that the funds have got their positions locked and loaded. They're probably short a little bit of corn. They're probably going to go into this report long 80 or 90,000, possibly 100,000 beans, and they are short about 100,000 wheat. Wheat was 2 cents lower again today. Wheat's really fighting it out. I did make some recommendations in a letter this morning for anybody that needs hedges. You do not have to spend a whole lot of money, guys. That's one nice thing now with these shortly dated options. You can protect old crop corn, new crop corn for the next 18 days if you use the February dated options. If you want to go to March, that's fine. The whole idea with options is you get your risk on paper. So nobody knows where the price is going to go. Nobody also wants to be sitting here. We don't get these corn at 461. We don't want to be sharply lower and go, well, gosh, what could I have done, for on the cheap? And you can spend very, very little to get a floor. And then that way, what you want to have happen, you want to, it's like paying your life insurance premium. You don't cut the check for your life insurance and then go skydiving with no backup chute, right? You don't put those. You really don't want it to pay off. That's the way to put option is. You want to make money in the cash market, but you also don't want to get run over if we fall out of bed. And we just had a perfect example of that. We had $1.58 rally in beans from October to November, and then we dropped, $1.35 of it. So when you get those rallies, you want to get aggressive with some hedging strategies. And again, if you don't want to sell the grain, but you'd like to capture the revenue, unfortunately, there's a cost associated with doing anything. There's a cost associated with protecting. There's also a cost associated with doing nothing, right? So it all comes down to a personal choice. If you're looking for help for that, give me a call, 312-638-8868. I can give you some suggestions there as well. If you look at what's going on in bean oil and meal, we also had a pretty severe sell-off, a correction. If you look at bean oil basically gave back half of the entire 18-month rally. Soybean meal also, once we fell below the $3 level, accelerated lower. So what does that mean? Well, if I'm an end user and I'm somebody that uses a ton of meal, and there are guys out there I know, you feed it to your hogs. Some of you guys have got catfish operations where you're constantly buying meal, so you're constantly short meal. So when we're at 3 or 4 or 5 month lows, it makes sense to get some protection on it. Again, not because we're predicting we're going to have a drought, go to the moon, and you're going to, make it, get long and retire, that type of trade. It is a business decision. So that's really what I try and stress out. If you've got business risk, right now calls are very, very, very cheap. In the wheat, we finished the day down 2 cents, 10 and a half, with only a nickel range. Pretty. Not a lot of people trading at all. I think it's still pretty early. I think people are going to wait and see, kind of hanging fire. Today's the 6th. The report's on the 12th. We have Wednesday, Thursday, Friday, then boom, Monday at 11 a.m. So you got some time to do some stuff. The good thing is you do not have to spend a whole lot of money. And if you're looking for suggestions, give me a call, 312-638-8868 in the protein complex. Well, feeder cattle just will not turn around, right? Now we're $65 off the bottom, right? More than that now. We the bottom in March feeders was 293.30. A lot of people thought that we would take a pause once we hit the gap there in October at 353. Nope, we're sitting here today about to trade 360. And then if you keep looking at where there's some technical targets, there's a gap in the charts that goes back to the middle of October, around between 370 and 375. So are we going to get another 10 or $15? I sure hope so if I'm long feeders. Now, for those of you that haven't bought your calves yet for the next 6 months, there again, hindsight's 2020. People always say we always talk about puts. That break was a great opportunity for anybody that hadn't bought their calves yet to get some upside protection on. So is that still something you want to do? It's possible. I mean, what happens if this March feeders go back to 380? What happens when we get March feeders with a 4 handle? So yeah, try and get your business risk on paper. Now, the whole idea with that, if you are someone that's still haven't bought your animals yet, your calves, for you want to spend 2, 3, 4, 5 cents, whatever you're willing to spend. You want to lose it because you want the market to drop. We just rallied $60. You want it to drop 60 so you can buy your animals cheaper. So uh, it's the same way you look at if you're long at something, you buy a put, you don't want it to pay off. If you're short something, you buy a call, you really don't want it to pay off. It's there in case the market moves sharply against you. So don't want to beat a horse to death, but that's really what it comes down to. Nobody's reinvented the wheel here. The key is try and get your risk on paper. For the day, April fat cattle finished up 57 cents. We opened up at 37, traded to 38.20, settled at 37.30. So nothing tremendously wild going on there. Although it is a new high for the move. Can't talk about that. That means it's another 10-week high, 2.5-month high, whatever you want to call it. If same thing for feeder cattle, another 2.5-month high here, a new one today. We did trade as high as 359.40. We didn't get the 360 print. Again, are we going to go get that gap above that's north of 370? Your guess is as good as mine. Just get your risk on paper. And in the hogs, a tight trading range, a dollar trading range, not a whole lot going on there. Maybe $1.40 trading range, $1.40 trading range in the April lean hogs. We did make a new high for the move. We did settle higher on the day, but it feels like, out of all three of these, it feels like hogs may be running out of gas first. The managed money remains bet long across the board in the protein complex. They remain, flat to maybe short a little bit of corn. They remain long soybeans and short wheat. They're also short canola, meal, and oil now at this point. So that's where we're sitting right now. Again, if you're not getting my letter, I did send out this morning specific ideas. It's in the letter. If you'd like to see that, give me a call, send me an email. I'll forward it to you. Robinson Ag Marketing. This is Chris Robinson. Have a great day. Thanks for your time.